This is video of the class that was to be held on January the 28th. Unfortunately, I had some technical issues and I couldn't engage with the Blackboard classroom, so I had to cancel that class. But this video is in lieu of the presentation that I would have been making on January the 28th, and this is part of again our Category 1 study, and this involves engagement planning, specifically client acceptance and continuance, and preliminary engagement activities. So let's go ahead and start off with what I call my 10,000 foot overview slide. And this you'd seen in our previous uh, classroom presentation, but I call this a 10,000 foot overview of a financial statement audit. Now, again, if we take a look at the process here at the top, we can see a business records it basically, in producing financial statements, a business normally has obviously processes transactions, again, through processes that are recorded in the books and documented in company records. All this information is put together and assembled into typically a group of financial statements utilizing what we call some form of financial reporting framework. In the United States, that financial reporting framework is called generally, or is normally called, U.S. Generally Accepted Accounting Principles. A couple of other frameworks that you could be exposed to also is that we could have a framework which was produced through International Financial Reporting Standards, or IFRS, or even more likely another framework which we call an SPF, Special Purpose Framework. But anyhow, we utilize our transactions, processes, books, and records and build them into financial statements following one of those, or different financial, or a particular financial reporting framework. Now, the purpose of an auditor during a financial audit is to examine the evidence that you see up here above: transactions, processes, books, and records, and so forth, that make up financial statements, and examine that evidence and determine that, based upon the evidence examined, that the financial statements have been prepared in accordance with the framework and there's no material misstatements in the financial statements themselves, and that's part of the evidence gathering process. When the auditor gathers that evidence and has enough evidence that they can conclude, they will write an independent auditor's report, which will conclude on the fact that the financial statements were prepared within a particular financial reporting framework, and on top of that, that the information within the framework is fairly stated, or in other words, another way of saying it is not materially misstated. So that's what the auditor does, basically, from the 10,000 foot view. Now, the thing about it is, an auditor just doesn't do this and just decide, oh, I'm going to do this and I'm going to do this or whatever. The auditor follows a specific set of, in effect, foundational procedures, and must follow these procedures or consider these procedures as part of the audit. These are called generally accepted auditing standards. So when an auditor says that they have performed an audit in accordance with generally accepted auditing standards, the reader of that knows that the auditor has performed a specific set of procedures based upon generally accepted auditing standards. Now, the purpose of generally accepted auditing standards is to obtain reasonable assurance about whether financial statements are free of material misstatement, and number two, then report on the financial statements and communicate basically in accordance with the auditor's findings. So that's what the generally accepted auditing standards do. Now, generally accepted auditing standards are issued by two bodies, two authoritative bodies in the United States. One is called AU-C, or Audit Standard, or Clarified Audit Standards, and these are issued by the American Institute of Certified Public Accountants. So these are the audit standards that have been issued by the Auditing Standards Board of the AICPA. We have another group that also issues audit standards, and these are called AU audit, or basically they call them AU audit standards or auditing standards. These are issued by the PCAOB. And as I mentioned in my class, the previous live class, there was a reason. At one time, the AICPA was the only authoritative body issuing audit standards, but because of the accounting scandals that occurred in the early 2000s, of the late 1990s, uh, the government created, essentially through the Sarbanes-Oxley Act of 2002, the government created an independent board called the Public Company Accounting Oversight Board, or PCAOB, which was now charged with creating auditing standards for any auditor performing audits of what we call listed, or companies that are subject to the Securities Exchange Commission. Now, the first thing auditors typically do when they hear this, or not, I shouldn't say auditors, but students, they go, oh my God, there's two standards. Now, I'm going to have to learn two standards. And the truth is, there are two standards. One is issued by the AICPA for non-listed entities, and the other one is issued by the PCAOB for listed entities. And I'll talk a little bit more about those over the next couple of slides. Okay, now let's take a look at what I call the hierarchy of generally accepted auditing standards. And let's start off with the middle box here, where we say auditing standards, generally accepted auditing standards. These are the actual standards that are to be followed by the auditor when performing an audit. So when an auditor says that they have performed in accordance with generally accepted auditing standards by the AICPA, the person who reads that can understand the fact that the auditor followed specific procedures as prescribed within the code of the statements on auditing standards to the AICPA. If the auditor says they followed PCAOB standards, the reader would know that the auditor followed the procedures as prescribed under auditing standards by the PCAOB. Now, again, as I'd mentioned in the previous slides, students normally go, "Oh my God, I've got to pay attention now to two totally different standards." Well, the good news, at least for this point in time, the standards overall between the PCAOB and the AICPA aren't drastically different. Now, typically on the CPA exam, what you're going to be responsible for are the auditing standards of the AICPA. However, there can be cases where the auditing standards of the PCAOB do differ significantly from the audit standards by the AICPA. And on the CPA exam, they will test you on the differences. So during this course, what you're going to see in the Liz Kohler videos and my presentations, if the audit standards differ significantly, you'll see both her or her instructors and myself referring to those differences. Now, no matter whether we created audit standards through the AICPA or the PCAOB, auditing standards have their basis in what we call fundamental auditing principles, or fundamental auditing standards principles. The principles are basically the fundamental principles are the principles that drive and help create the audit standards. These principles are found in three major categories: general standards, standards of fieldwork, and standards of reporting. Now, the AICPA reports basically has its fundamental principles located within its audit standards under what they call AUC- or Section 200. The PCAOB has audit standards under, I believe it's section AS 2100. Now, again, we don't have to worry too much about the differences because overall they kind of back each other up. So anyhow, we have fundamental principles. Now, the fundamental principles are not, uh, in effect, standards that we enforce. What we do is we create standards from those principles, and auditing standards are the enforceable standards. In some cases, there are situations that do not necessarily fit the standards, so both bodies, the AICPA and the PCAOB, have developed interpretations regarding some of those standards. So the interpretations basically are the result of the authoritative body addressing those specific situations. And under those conditions, the interpretations are basically the equivalent of the generally accepted auditing standards. Now, we talked just in our previous slide again about the fundamental principles, and we switched to auditing standards from where we derive the standards from those principles. Now what I'm going to do on this slide is show you the listing of the audit standards as written by or audit standards as categorized and listed by the AICPA, which when I say ASB, that's Audit Standards Board of the AICPA. And again, these audit standards are referred to as clarified standards, or right now they're called AU-C. And you can see down here, you can see the individual sections of all the standards. In the case of general principles and responsibilities, that would be AUC dash or AUC section 200 through 299. Risk assessment and response to assessed risks, that would be under AU-C 300 through section 499. Now, if we take a look at the right-hand side, we see the corresponding audit standards that are listed by the PCAOB. And again, they're referred to as auditing standards, or AS. And again, this is for listed companies. So the auditor, if they're going to perform an audit of a listed company, they would perform the audit standards according to the AS type of standards listed by the PCAOB. And you can see under auditing standards, we have general auditing standards, and this is basically standards 1000 through 1300. Then we go on to audit procedures. And what I've done is I've aligned the AICPA standards, generally speaking, with the PCAOB standards. So when you take a look at general principles and responsibilities, that section there are sections 200 through 299. That corresponds to general auditing standards, standards 1000 through 1300. When I go on then to the section in the AICPA called Risk Assessment and Response to Assess Risks, that is contained in AUC sections 300 through 499. The risk and the equivalent information is listed in the PCAOB as audit standards 2100 through 2900. I go then to the AICPA audit standards, where then it has a classification called audit evidence, and that's in sections 500 through 599. And again, if we look at the equivalent, that is still contained in audit procedures, audit standards 2100 through 2900. So you can see the equivalent audit standards under the AICPA to the PCAOB. And again, I'll remind you, these standards are fairly much the same. They may use a little different wording, but overall they're pretty much the same. And again, Liz or I will alert you if there's significant differences in the standards. Now we're going to take a look at AICPA audit standards compliance. And the first thing we're going to look at is what we call attestation standards. Now these standards are located, if you want to look at the literature, in the audit standards codification rather, under AT-50. Now, if you remember from our first class presentation, we talked about attestation versus audit. What is the difference? And if you remember, what we said is a financial statement audit or an audit is a subset of an attestation. So the AT or the attestation standards, and when I say standards, these are basically the fundamental concepts, apply equally to an auditor who's performing an audit. So we'll start off with what we call the general standards. The first standard is the member must have adequate technical training and proficiency to perform an engagement. In other words, typically, again, under that type of standards, the person who's in charge of performing the audit is going to have the educational qualifications, is going to be a certified public accountant, may even have other types of certification. So what is, again, it's saying the person has to be technically trained. If you were to board an airplane uh, and going to fly somewhere, you'd want the pilot to be have the adequate technical training and the proficiency to fly that airplane. Same thing with the auditor. Okay, number two, the member has adequate knowledge of the subject matter. And when the auditor is going to perform an audit or an attestation engagement, the auditor has to know enough about the subject matter to make basically informed judgments about that. So this would make sense when you think about it. Same thing with the pilot. You know, if you get aboard an airplane and the pilot goes, "Oh, this is the first time I've ever flown this type of airplane," well, it's not such a good thing. Okay, number three, the member has reason to believe that the subject matter is capable of evaluation against an established set of criteria. Remember, with an attestation, the auditor is looking at something a client has created and will compare that against an established set of criteria and issue an opinion as to whether or not that particular uh, information that the client has created complies with that set of criteria. And again, when we do audits, the subset of the attestations, we're doing that typically against generally accepted accounting principles, IFRS, or special purpose frameworks. Number four, the member must maintain independence and mental attitude in all matters relating to the engagement. And this goes back to when we perform an attestation, what we're doing is we're basically providing an assessment as to whether or not the information that was created and assembled by a client conforms to certain criteria for the benefit, so third parties know that that was done correctly. We have to maintain an attitude of independence under these conditions. And the last area, the member must exercise due professional care in the planning and performance of the engagement. Okay, now let's talk about the objective of an audit. And this comes from the generally accepted auditing standards, or in effect, principles of generally accepted auditing standards. And this comes from Auditing Standard, Clarified Standard, AUC 200. And again, this is through the AICPA. So the objective of an audit is provide financial statement users, okay? In other words, third parties with an opinion whether the financial statements are presented fairly, and we'll come back to that in a second, are presented fairly in all material respects in accordance with the applicable financial reporting framework. And as I mentioned before, the framework is ordinarily GAAP, although it could be IFRS, or it could be a special purpose framework, or it even could be another accepted financial reporting framework, as long as the applicable financial reporting framework corresponds to the suitable criteria of an attest engagement. In other words, something you can measure it against. Now, when we say presented fairly, what that means is it means the financial statements as a whole, not the little different parts of them, but the financial statements as a whole are free from material misstatement. So that's what we mean by presented fairly. Financial statements, when we take them as a whole, are free from material misstatement. Now, that goes up, well, wait a minute. Now, here's another word, material misstatement. What does that mean? Does that mean that we, iron ore? Does that mean plastic? I mean, materials? No. What material means in the accounting world, at least in the audit world, means it's an amount or a difference in the financial statements that could affect the decision of a user of the financial information. In other words, if you had sales of $1 million and those sales were off by $100, so they're off plus or minus $100 on $1 million. The question would be from a reasonable financial statement user, would that really affect their decision regarding, let's say, sales or the company? And the answer is probably not to 99.9% of users. It would not be a material difference. It would not cause them to change or alter their decision, basically based upon that type of financial information. When the amount gets to a significant or a portion that tends to be significant to that particular financial statement element or the financial statements, at that point, that amount could be considered material. Now the question is, what is material? And we'll find out as later on, probably in our third lecture. As a matter of fact, the lecture on, I believe, February the 5th, what we're going to find out is material can have, the word material can mean a lot of different things to a lot of people. And sometimes, I shouldn't say sometimes, but materiality is has a lot to do with the auditor's professional judgment. Now, in order for an audit to happen, we have to have kind of a premise for the audit to actually occur. Okay, management and those who are charged with governance, in other words, the people who govern management, have the responsibility to, okay, and this is really important, it is prepare financial statements in accordance with the applicable financial reporting framework. And what that means is that the auditors are not responsible for the information in the financial statements. They are responsible for determining whether or not that information conforms to a financial reporting framework and is presented fairly. But in no way are the financial statements basically should be considered as being literally prepared by the auditor. The financial statements are those of management and those charged with governance. The auditor provides an opinion. Okay, the other thing is another premise of an audit is that the management and those charged with governance have the responsibility to provide the auditor with any needed information and unrestricted access to those people, or not only to the people in the entity, but I should add also third parties where the auditor needs information from third parties. If the auditor is not able to provide or not able to obtain the needed information or has restricted access, the auditor is not going to necessarily be able to accumulate the evidence that needs to be accumulated. Now, again, from principles of generally accepted auditing standards from this standard called AUC 200. Now, in terms of professional responsibilities, and again, we go back and it's stated within the audit standards, the auditor must be independent with respect to the client, and that has to be, and we talked about under the AICPA audit standards in terms of the auditor's, in effect, responsibility in terms of making sure that they're independent with respect to a client. There's a lot of, and as a matter of fact, again, as I mentioned to you, that's where that independence is tested quite a bit. This is nothing more than a summary of what we would find in the AICPA Code of Conduct. Independence in fact and appearance, and independent of financial and managerial relationships with the client. So independence is a cornerstone. Okay, now there is an exception to that under the AUC 200, and what this says is the independence the independence requirement always applies unless the auditor is required by law or regulation to accept the engagement, even if they're not independent, and report on the financial statements. So what happens is if there's a law or a regulation that requires this, even though the auditor is not independent, the auditor can comply with the AUC-200 standard. Okay, the next item is professional skepticism. And what this means is it's an attitude that includes a questioning mind, being alert to conditions that may indicate possible misstatement due to error or fraud, and a critical assessment of the audit evidence. And what I say with this is when I've talked to classes before, I say, okay, professional skepticism means prove it. The client is not your friend. The client is basically a person you may have to be independent from and assess the information that they're providing you with that type of professional skepticism. So the client is not your friend. Even if they take you out to lunch, they're still not your friend. Okay, on the other hand, the client's not your enemy either. So you can't sit there and say everything coming to me is going to be fraudulent or whatever. You just need to say, I need proof of this information. I need proof regarding this particular assertion or information. The third area is professional judgment. And this is where it's the application of an auditor's relevant training, knowledge, and experience within the context provided by auditing, accounting, and ethical standards in making informed decisions of actions that are appropriate in the circumstances of the audit engagement. So a lot of times we say an audit standard, you have to do something according to an audit standard, but you also have to apply professional judgment many times regarding that standard. Okay, sufficient and appropriate evidence. In other words, as I mentioned in the first slide that we had gone over, the auditor needs to apply basically their examination of the books, records, processes, and so forth to obtain sufficient and appropriate evidence. And here's what I say here. To obtain reasonable assurance, the auditor should obtain sufficient, appropriate audit evidence to enable the auditor to draw reasonable conclusions on which to base the auditor's opinion and thereby reduce audit risk to an acceptably low level. Now, I'm sorry about that last word after level, and that's a typo, obviously. But I have a couple of definitions here about obtain sufficient and appropriate audit evidence, and I've got a new term in here that you haven't heard before. I say reduce, then audit risk. So we're going to talk about these items right now so we can define them, and this will hopefully make this definition will make more sense. Okay, the word audit risk is a very common term under audit standards. And audit risk means, and remember we all know what risk means now since we've gone over, I told you risk is going to come up a lot during the your audit your audit classes. What this means is audit risk is the risk. In other words, the possibility that the auditor may issue the wrong audit opinion. Now, let me give you an example of that. I issue an audit opinion saying everything's fine. And now that's not truly a formal opinion. I'm just saying that my audit opinion says to the third-party users that I've examined the financial statements and everything looks like it's in accordance with the framework and there's no material misstatement. Okay, however, nothing is perfect. In other words, I could make a mistake, even though I've done a lot of work and so forth, and I'm pretty much convinced that's the case. There is a possibility because I can't come up, unless I look at everything and talk to everybody about everything, there's a possibility that there could be some type of error, or in effect a material error within the financial statements. So what that means is that the risk the auditor may issue the wrong opinion. I may issue what I call a clean opinion saying everything's fine, yet the financial statements are materially misstated. In other words, I made a mistake performing and applying either professional judgment or against audit standards or so forth. Now, when that happens, the auditor can suffer a significant amount of liability. In other words, there's a very good chance that the auditor is going to be, in effect, sued by a number of different people. So the way we can reduce our audit risk to, and I say to an acceptably low level, in other words, not make a mistake, is develop enough sufficient and appropriate audit evidence so we can draw a reasonable conclusion about the audit opinion. And when I say to an acceptably low level, in other words, audit risk cannot be eliminated because there's always a chance we're going to make some type of error along the way. So we can never eliminate it. We can though perform sufficient audit procedures through the audit standards to develop sufficient and appropriate audit evidence to bring audit risks down to an acceptably low level. So that's what we mean by uh, audit risk. Now I say sufficient appropriate, then I say audit evidence. Okay, audit evidence is probably self-evident, so to speak, to you, but it basically means the evidence the auditor uses with which to apply professional judgment and issue an audit opinion. Now, this audit evidence comes in a couple of different forms, and what we have to understand is that audit evidence, in order to be sufficient and appropriate, has to be, basically, we have to have a certain amount of quality of evidence. In other words, audit evidence quality. In other words, the appropriateness, in effect, is the quality of the evidence. If we want to have audit evidence, is how much is in your cash account, your cash balance. The controller of the company says we have $100,000 in our bank account. Okay, now that audit evidence taken as a testimony from a party within the company, taking it upon the fact that that's the only evidence, is basically you have to consider whether that information would be appropriate for confirming that $100,000 balance. In other words, is it reliable? Can the auditor trust the controller? Number two, is the evidence relevant? Well, if the controller says there's this much money in here, it would be relevant, but can it really be reliable? Because we're talking about cash. Most auditors would say, no, I can't take the guy's word for it, because we already talked about the fact that we need to be professionally skeptic. So the auditor would go ahead and most likely confirm that cash balance with the third party, being the bank, because the bank is independent. The bank is not an employee of the client and so forth. So the bank can independently confirm that, meaning that evidence is going to be, not only is it relevant, but it's also going to be, probably from the auditor's point of view, reliable. The auditor can trust that type of evidence. Now, the other area in terms of sufficient appropriate is sufficiency of the audit evidence, and that basically is the amount of the audit evidence. Obviously, the more evidence supporting a particular objective or an assertion or so forth, the better. In other words, evidence sometimes, if it's not necessarily direct, sometimes we have to obtain our evidence indirectly. In other words, from several different independent sources who will help, in effect, corroborate the information. So the auditor can say, okay, it's now going to be a sufficient amount of evidence. So that's what we mean when we say to obtain reasonable assurance. The auditor should obtain sufficient appropriate audit evidence, basically to draw reasonable conclusions. And that will basically, examining that audit evidence and applying professional judgment will help reduce the audit risk of the entity. Okay, now this we went over with originally in our first class, but again, this is very important. When we're dealing with the auditing clarified standards, generally accepted auditing clarified standards. Again, first of all, we are required to comply with all AUC, all clarified sections relevant to the audit. Now, what it also said in the clarified standards is that the auditor should not represent compliance with generally accepted auditing standards in the auditor's report unless the auditor has complied with the requirements of this section and all other AUC sections relevant to the audit. So in effect, we can't say we complied unless we complied with all the sections relevant to the audit. Now, as I had mentioned, in the audit sections, they say there are certain words that will tip the auditor off as to what sections have to be complied with, or where the auditor can replace those standards with something else or can ignore those standards. And again, this is comply with all AUC sections, clarified sections relevant to the audit. Okay, the sections containing the words must, shall, and is required indicate unconditional responsibilities if the audit standard applies. In other words, if that audit standard actually applies, you have no choice. You have to apply that audit standard and any of the procedures that audit standard requires. Then we have the word should. Okay, that indicates responsibilities that are presumptively mandatory. So the auditor has to comply with these except in cases where the auditor demonstrates or can demonstrate that alternative actions followed in the circumstances were sufficient to achieve the objectives of the standard responsibility, again, if the standard applies. So normally they're presumptively mandatory, but if we have another standard that could take its place and probably be more effective, we could do that. Now, lastly, the words may, might, and could, and similar terms and phrases describe actions and procedures that the auditor has a responsibility to consider. How and whether the auditor implements these matters in the audit will depend upon the exercise of professional judgment in the circumstances and consistent with the objectives of the standard. So if you get a standard that says may, might, or could, you have an obligation to determine whether or not that standard should apply, but you can, if you decide you don't want it to apply, you have to have basically you take responsibility as to whether or not that standard should apply. But again, if that standard is not going to apply, you probably need to make sure that you have some documentation, some judgment that or some documentation that shows how you use that judgment. That sort of documentation is always nice to have when you're being when your work is being reviewed, or eventually if your audit ends up in court. Okay, now we're going to do a very brief, in effect, simulation. And this is a pretty simple simulation, but it deals with level of compliance required for, again, clarified standard sections containing certain words. So over on the left-hand side, it says a standard containing the word, and that we have different words: must, should, may, is required, and could. And we have to determine over on the right-hand side the level of compliance each of these particular words implies. And again, if you've seen this in an AICPA, or rather CPA exam simulation problem, you'd see something like this, and the level of compliance would have a drop-down box, which would have the numbers 1, 2, and 3, along with the levels of compliance, and you'd have to pick from every time you have the drop-down box, pick the level of compliance. So why don't you go ahead and go ahead and stop the video, and when you're ready, do your simulation. Then when you're ready, restart the video, and we will go over the answers to the simulation. Okay, let's take a look at number one, the answers to simulation number 1. And what we see here is we start off with the standard containing the word must would be the level of compliance would be 2, a mandatory standard that must be followed. Then we have B, should, and that would be number 1. The auditor must comply except in cases where the auditor demonstrates the alternative actions followed in the circumstances were sufficient to achieve the objective. C would be number 3, which is may, in audit standards where the auditor has a responsibility to consider but not necessarily apply. D is required. That should be pretty easy. That's drop down box item number 2, mandatory standards. And then E is could, and that is an audit standard again where the auditor has a responsibility to consider. Okay, so those are the answers to simulation, in this case the simulation for number 1. Okay, now let's continue on with the fundamental generally accepted accounting principles, again as they apply through the in effect the attestation standards and also through the AUC 200. Now we have a reporting group, and this basically has 3 major components in the fundamental generally accepted accounting principles. Remember, these aren't standards, these are fundamental principles. Okay, in reporting, one of the principles is to express an opinion in the form of a written report based upon an evaluation of the audit evidence obtained, or state that an opinion cannot be expressed. In other words, if we can't obtain enough sufficient and competent, in effect, audit evidence, we've got to state in our audit opinion we can express an opinion. Okay, now if we do express an audit opinion, there is an audit opinion format. And again, the formats between the AICPA and the PCAOB are fairly much the same, but I can show you a couple of differences. So if we take a look at the audit opinion format, one of the things is that within there, basically we have to spell out the auditor's responsibility in the financial reporting process. We also spell out management's responsibility in the financial reporting process. And what we're going to see is the auditor's responsibility is for examining the financial statements and providing an opinion. And management's responsibility is for the creation of the financial statements. Also, we say what type of standards we utilized in conducting an audit. In this case, the audit was conducted in accordance with auditing standards. In the case of an AICPA, it would be the auditing clarified standards through the AICPA or the audit standards from the PCAOB. We then have to provide an opinion on our financial statements. Again, the opinion whether or not they are presented fairly. And the wording is a little bit differently between the AICPA and the PCAOB, but we'll get into the audit opinion format later on in the course and how they are that much different. So this is again from the 10,000 foot level. Another thing is that the auditor may or may not have to express an opinion on internal control over financial reporting. Now, under AICPA standards, that can be optional or mandatory depending upon the audit. The AICPA does not require that the member report on internal controls, and in fact basically internal control over financial reporting, but in some cases there is a requirement in the audit that the auditor reviews that. If that's the case, then there is an opinion as part of the internal control on financial reporting. In the case of the PCAOB, it's mandatory that there's going to be an opinion on internal control over financial reporting. So again, these are 10,000 foot views of the audit opinion format, and again, we will get into this in much more detail later on when we look at the detail of audit opinions. Okay, now audit opinion types, and again, this is from the 10,000 foot view. They can come in four flavors. Okay, number one, what we call unmodified or unqualified. Now confuses students, but let me go with this first. Unmodified. What that means is financial statements are in conformity with generally accepted accounting principles and follow the financial reporting framework. Now, what that means is that the auditor normally wants to put out a standard opinion saying everything's okay. So that's what we mean by the word unmodified. If we have to modify it, there's something possibly wrong with the financial statement. So modified means we may have to change the wording of a standard, basically in effect clean audit opinion. Also, we also use the word unqualified. Now, to most people go, well, wait a minute, if a financial statement isn't qualified, that means something's wrong with it. No, not in this case. Unqualified means that the auditor had no reason to qualify the financial statement. In other words, say, except for, or something's wrong with it, or so forth. So unqualified actually means in auditese a good thing. So unmodified, unqualified means the financial statements are in conformity with generally accepted accounting principles. Okay, the next type of financial statement is a qualified financial statement. And that doesn't mean it's good. It means there's some type of issue within the financial statements. Okay, qualified means except for a limited item or items, the financial statements are in conformity with generally accepted accounting principles. So there could be a situation where the auditor has noted that, as an example, the company had decided not to include in their financial statements a reserve for doubtful accounts or for bad debts. Well, under generally accepted accounting principles, that is, the company under accrual basis accounting has to include a reserve for bad debts as long as that reserve is material to the financial statements. So in this case, the auditor may issue what they call a qualified opinion, saying that basically, except for the reserve for bad debts, which was not included on the financial statements are in conformity with generally accepted accounting principles. Okay, there's another type of opinion is an adverse opinion. This is the worst one you can get. The financial statements taken as a whole are not in conformity with generally accepted accounting principles. And the last one is a disclaimer where the auditor has gone through the financial statements and for some reason, typically again insufficient amount of evidence or inability to accumulate the evidence or some type of prohibition to the auditor in obtaining the evidence, the auditors in effect will issue an opinion where in effect they do not express an opinion on the financial statements. Now this is an example. In this case, I believe it's of McDonald's Corporation. And this is out of an excerpt out of an old textbook. Well, I shouldn't say excerpt out of an old textbook, a textbook for 2016 that basically gives you an example of the independent auditor's report we were just talking about earlier. And in this case, this would be for a publicly traded company, and that makes sense. Obviously, the McDonald's is a publicly traded company. And the independent auditor's report is the outline of it, of what you should say in it is in the audit standard, the PCAOB audit standard 3101. And again, you can see the different section titles, report title, addresses. And again, I'm not going to go into details simply because we'll go into this in excruciating detail during the opinion lecture. There will be a scope paragraph. In other words, there's basically an introductory paragraph. In other words, why this report's being issued. Scope paragraph. In other words, what we looked at. The opinion paragraph, and then the report on internal controls. An internal control report basically is part of requirement again under the Sarbanes-Oxley Act for publicly traded companies. Now, what I'm going to go here next is take a look at an example. And again, if this is hard or impossible to read, I apologize. Unfortunately, I tried to get this all on one page. And this is basically the independent auditor's report if you're a non-listed company, if the auditor applies the AICPA audit standards. Now, if you actually want to look at this report, the detail of this report, it is in Appendix A of Section Clarified Standard AU-C, Section 700, and then it's in the appendix. And again, it includes the report title, the addressee, the introduction, talks about management's responsibility for the financial statements, the auditor's responsibility. Now, in this case, you're going to see this report does not include a review on internal control because this was not required for this particular audit in this example. Then we see the audit opinion signed by the auditor and so forth. So again, you're welcome to review the detail, and again, I will assure you that we will get to that detail, like I said, in excruciating detail later on in the course. Okay, now CPA firms also, in addition to having not only the auditing fundamentals that they follow, generally accepted auditing fundamentals and standards, CPA firms also have quality control programs. And the reason for that is the CPA in effect creates a quality control audit of its operations and standards to see that it complies with the various quality control goals of an organization. So these quality control standards again are listed under the auditing codification under statements on quality control standards, or in short SQCSs, codified as section QC-section 10. So sometimes you could get a question or two on quality control standards. So we're going to take just a minute or two and go over these standards from a fairly high level. Okay, one of the quality control standards, review standards that the quality control reviewer does is go through basically leadership, in effect the tone at the top of the CPA firm. And that means things like establish an internal culture indicating quality within a firm, within the audits is paramount. Also, making sure performing work that complies with professional and legal standards. And number 3, issuing appropriate reports. Okay, also another major section is relevant ethical requirements. And again, that will be where the quality control people will help ensure that the auditors maintain compliance with the AICPA Code of Professional Conduct, especially in the independent area. Okay, another area is in the area of acceptance or continuance of client relationships and specific engagements. And one of the reasons for that is that many times if an auditor has had a problem with the client in the past, the client has tried to play false or loose or tried to propose or sneak through adjustments to the books that basically could distort the information, they're kind of hoping the auditor will just let it pass or whatever. Those type of clients who are basically pains in the rear end. And basically those type of clients, when you think about it, can increase your audit risk significantly. So sometimes when we have a continuing client, we have to look at that client again and say, do we really want that client around? Are the fees that we're going to earn from this client worth the additional audit risk that we basically incur? The other thing is when I say that's continuance. Now, another word is the acceptance. In other words, when you have a new client, you probably don't know too much about them. So you're going to have to do research regarding that client, whether or not they'd be the right type of people to work with. And we'll talk about that more later on. So when we say acceptance or continuance of client relationships, basically, again, we have to base the quality control standards helps ensure, basically, they look at the firm and say, did the firm have the capability and resources to perform the work? Number two, can the firm comply with legal, regulatory, and ethical requirements with this particular client? The firm has sufficient personnel with ethical principles and capabilities to perform engagement within the professional standards. So these are all the items the quality control reviewers are going to go through for each engagement. Engagements are performed within professional standards. And lastly, system of quality control should be documented and monitored. Now, we'll continue on to human resources. The human resources side in the public accounting firm, that includes processes over hiring, training, retention, performing work that complies with professional legal standards, and also issuing the appropriate reports. Quality control includes engagement performance, policies and procedures to provide reasonable assurance engagements are consistently performed in accordance with professional standards and legal regulatory requirements. And lastly, monitoring, policies and procedures to provide reasonable assurance engagements are consistently performed in accordance with quality control standards. So with that, let's take a look at a question or two regarding that information we just went through regarding quality control standards. Okay, question number 2. The purpose of quality control policies and procedures on whether to accept or retain a client is to A. Ensure the existing resources of the firm have been adequately trained to carry out their responsibilities. B. Document the client acceptance retention analysis process for peer review. C. Minimize the risk of not complying with the AICPA professional standards. And D. Minimize the risk of accepting a client where executive management lacks integrity. All these seem kind of good. So again, you have to carefully read this particular question. And again, I'll emphasize the purpose of quality control policy procedures on whether to accept or retain a client. So keep that in mind when you're looking through these particular procedures. So go ahead, look at the procedures, stop the video, and when you're ready, restart the video and take a look at the answer. Okay, number 2, the purpose of quality control policies and procedures on whether to accept or retain a client is to, and again, there's a typo there with the question mark at the end. But the answer in this case would be D. Minimize the risk of accepting a client where executive management lacks integrity. If we take a look at B, if we take a look at A, is ensure the existing resources of the firm have been adequately trained to carry out the responsibilities within the firm. That would be that would be as a human resource function category under the quality control standards. B then is document the client acceptance retention analysis process for peer review. B, in effect, documentation isn't the reason of quality control for client acceptance and retention. That's kind of an after the fact thing. C, minimize the risk of not complying with AICPA professional standards. And again, that's not the reason for basically the quality control of client acceptance and and retention. Let's try number 3. Which of the following is an element of quality control of a quality control system that should be considered in establishing a CPA firm's quality policies and procedures. Again, we have A, using statistical sampling techniques to reduce audit risk. Now, we've already been, you don't know too much about statistical sampling, but I think you can pretty much understand what it is. You have learned about audit risk. B, managing human resources to ensure only qualified individuals are assigned to the engagement. C, consideration of the potential materiality of errors, and we have also learned what the word materiality means. D, a system of peer review. So again, take a look at the question and your answers. Select the correct answers. Don't forget to stop the video, and when you're ready, you can restart the video and review the answer. Okay, number 3. Which of the following is an element of a quality control system should be considered in establishing a CPA's firm's quality policies and procedures? And the answer is B, managing human resources to ensure only qualified individuals are assigned to engagement. If we look at A, using statistical sampling techniques to reduce audit risk. Okay, really, reduction of audit risk is not a goal of a firm's quality control. B is the correct answer. Then C, we talk about basically consideration of the potential materiality of errors. Again, materiality is not a goal of quality control. And then D, a system of peer review. Peer review is a process that is required by the AICPA and the PCAOB, but it's not part of a firm's internal quality control. Okay, now we're actually going to start talking about audit planning. And we're going to start talking about the audit planning phase. And the audit planning phase consists of three major activities. The first one is what we call client acceptance and continuance. Acceptance means a new client. Continuance means an old client that we're going to, consider for the new year. Number 2 then is preliminary engagement activities. In other words, some of the things we need to do before we start. And number 3, creating the audit plan. So in this particular scenario, rather in this particular presentation, this video presentation, we're going to cover items number 1 and number 2. So let's go ahead with client acceptance and continuance, and that means let's assume it's a new client. Okay, the first thing you want to be able to know about a new client is who are they, what makes them tick. What you don't want is a client that is is what I call a suspicious client, a client with questionable ethics, a client that plays fast and loose. All these items would tend to be items that could basically increase the potential of audit risk at the end of the audit. So you have to consider again, okay, if this client is potentially carries a little bit more risk, that means we're going to have to do more work on that client. That's going to raise the audit fees, and again, we have to make sure we would include that in our estimates. Now, again, in getting to know this new client, when we have this new client, these are some of the factors. Number 1, we need to obtain and review the financial information about the client. We need to inquire of third parties regarding the client's integrity. And I'll tell you, in a number of cases where I've done work for companies that are looking at a new client, we will do credit checks, especially when you get to the officers of the company and the board of directors, those charged with governance. Uh, it's interesting, but I've done extensive background checks to find out what these people were involved in, or what what's the reading on them financially, or had they been censured by the SEC, or have they committed crimes, things like that. Uh, because again, that goes to the character, and if it's at the board level or the executive level, that's tone at the top in terms of integrity. Consider unusual business or audit risks. In other words, are they in a business that can be considerably potential issues regarding the industry itself? Is it subject to significant fluctuations, or uh, in the case of an organization, let's talk about medical marijuana in Pennsylvania right now. That's you could create a company, or you could accept a client who is in the medical marijuana business, and if the federal government decides to close it down, they could close it down literally the next day, or whatever value the business has could disappear overnight. Uh, Determine if the firm, and being the firm, in other words, the CPA firm, based upon new client, now you're going to have new relationships. You have to determine if the firm is going to be independent, or does somebody who's, is there any type of relationship or covered member status that would occur with this particular client. Uh, Determine if the firm, the CPA firm, has the necessary technical skills and knowledge. If you're going to bring in a new client and you don't have the technical skills to examine that particular client, or the knowledge to deal with that client, you're going to have to basically either say, well, we can't really accept you engagement, the engagement, or you have to build a staff that has those skills. The other thing is, determine if the acceptance of that particular client violates any applicable regulatory agency requirements, uh, or the AICPA Code of Professional Conduct. So there can be cases where it may be lucrative to bring on a client, but the firm decides that the risks associated with that particular client may be uh, too great to service. So that can happen in a number of cases. Now, again, this is kind of a 10,000-foot view of audit risk. When we're looking, especially at a new client, this could apply to an existing client also. The difference is, a new client we're just learning about, an existing client we know a lot about, or we better know a lot about. So the real question is, can we accept the entity as a new client, or can we continue that entity as a current client? And then the question is, does the benefit of accepting or continuing with the client outweigh the costs associated with the audit risk associated with that client? And we kind of take at the beginning a holistic view of things. If you take a look at this upside down triangle over here on the right hand side, you can see it's at its widest point at the top, where we say inherent risks. Now this represents, in effect, the number of things that can go wrong. In other words, with this particular company, anything that can go wrong and adversely impact the entity's financial reporting that could result in some form of material misstatement. In other words, when we look at a company, anything that can go wrong. Now, when we talk about anything that can go wrong, the company normally looks at their own environment and builds up certain controls within their management structure, their financial control structure, and so forth. And what they do is that their controls and their management helps filter out these inherent risks. In other words, they've anticipated these particular risks and they have policies and procedures or other methods of mitigating many of those inherent risks. So these inherent risks get filtered out to some extent in the company's, in effect, control environment, or if you will, internal control environment. But it's not necessarily the control environment is not necessarily perfect. We'd like it to be perfect, but it isn't necessarily perfect. So what happens is that some of those risks that basically existed before they hit the company's control environment exist after they in effect get through the company's control environment. And these are what we call detection risk. These are possible material misstatements remaining after passing through the company's internal control environments. And at that point, then, this is where the auditor has to basically examine audit evidence in terms of they need to make sure, the auditor needs to make sure that these risks are identified or that these risks do not exist as they flow through eventually to the financial statements. So in effect, the auditor looks at what may get through the client's control environment. Then the auditor is going to have to develop tests or examinations of audit evidence that will provide the auditor with enough evidence to either issue a clean opinion, if you will, or some other type of an opinion. So the auditor, based upon they examine that audit evidence and the remaining risk that occurs after the auditor has examined the amount of evidence, or the evidence is basically those potential risks that the auditor missed. And that's what we mean by audit risk. And I say here, the risk that the auditor will issue a clean opinion even though a material misstatement actually is going to exist in the financial records. And the question is when we're looking at a new client, especially a new client, we're looking at this entire process: inherent risk, detection risk, the auditors or the entity's control environment that helps eliminate the risks. And what we're trying to do is, can we examine enough evidence that basically that will help us or reduce our audit risk to an acceptable level? So that's what we're really trying to do when we're dealing with client acceptance or even client continuance. But you can see, if we're trying to look at a brand new client, we have to research the environment. We have to understand what type of risks this company incurs. We have to understand the company's control environment to understand how it filters out those risks and so forth. Now, if we take a look at inherent risk, this is one of the more confusing things for students. Again, inherent risks are all the factors that could result in a material misstatement before the applications of the entity's control environment. So let's assume right now there is no control environment for the entity at all. Basically, the inherent risks will filter through the client's company, and those inherent risks will not necessarily be detected. So that means they're going to end up into the financial reports, and we can't, if we allow that to happen, we have a very, very high audit risk of issuing the wrong opinion. Now, what are inherent risks? Well, there's two types. One are risks outside the control of management. In other words, certain things that even management cannot control. As an example, we have to understand the risks to the company from the economic climate. Does a company react very, very negatively to a recession or so forth? Geographical location. Where is the company located? Is it diversified? When I say geographical location, a company that has operations in Thailand as an example, is different in terms of risk than a company that has operations in uh, Argentina, which has operations in Denver and so forth. So again, risk can be complex depending upon the geographical location. And also we have to think of the fact that if offices or facilities are located further and further away, they tend to act a lot more autonomously, meaning there's additional risks associated with those remote locations. The technological environment again. What type of risk may be incurred as a result of the technological environment? Uh, Nowadays, again, technology in terms of processing information plays such a large role. There's a huge amount of dependency upon that. Companies' competition. Again, a company's competition can induce risk. And again, that management can't control that. And as I mentioned, business volatility, which kind of goes along with economic climate. All these particular items, either independently or individually or combined together, can create additional risks to a company's financial reporting. Uh, Also, besides risks outside the control of the environment, risk due to the nature of the client and the business. Again, the integrity of management, and I'll treat these separately. But the integrity of management, that's not only executive management, but that's lower level management or upper level, those charged with governance. Again, if those people tend to be fast and loose or have ethical issues, those ethical issues are probably going to cause risks in financial reporting. As an example, I'm sure you've all heard of Enron. Uh, Obviously, there was a lot of ethical issues regarding the integrity of management, and a lot of that ended up as manipulations of financial reporting. Same thing with management in WorldCom, Adelphia, Tyco. We also know about Bernie Madoff and so forth. All those people, the tone at the top allowed them, basically, they created literally financial fraud. Competence of management. You can't have the wrong person in a place of responsibility. Uh, Meaning that if a person really isn't competent in their position, they're probably going to make incorrect decisions, or they're going to, even if they happen to have integrity, they may not recognize problems. Management incentives. This is the age old thing where when management is paid by bonuses or by stock options and so forth, they're going to have, in effect, as they say down south, the dog in the fight. And the information that pass through them may be subject to manipulation because of their type of incentives. And again, that's a risk. Complexity of transactions. The more complex a transaction is, an economic transaction, the more chance we have to make mistakes in that transaction. Inadequate capitalization. If a company doesn't have enough money to run or invest, that can lead to business risks. Lack of long run strategic and operational plans. If you have $1 billion company and it's running in all different directions, that creates a ton of financial risks. Dependence on a limited product range. If a company only has one or two products and its whole business operations depend upon those products, if competition or product obsolescence occurs, that can have all sorts of financial risk to the business's assets. We recognize a balance sheet is based upon a business being valued as a going concern. If a business is no longer going to be a going concern, the valuation on that balance sheet could change immensely. Uh, Dependence on technology. Again, this goes in with the limited product range that may become quickly obsolete. A company that makes games or different types of hardware, or even, as I say, games or software, so forth, or even some of the platforms like a Facebook or whatever, the technology isn't necessarily, may not necessarily become obsolete, but again, sometimes uh, many of these platforms or these basically become lose their popularity and their value. The same thing if you have technology, as an example, if you know the technology that existed 10 years ago now would be basically obsolete and worth almost nothing based upon today's technology. And again, the instability of future cash flows basically can have a gigantic impact in terms of the type of risks that be involved. So again, these are sort of things, especially with the new clients. See, these are sort of things that you have to be aware of. Now, it doesn't mean that you have to memorize these from the CPA exam standpoint. You just have to have a kind of like an appreciation for it. We know there's risks that occur outside of the control of management. That means what that really means also is that management has to have some type of risk assessment program that says these are the things that can go wrong in our environment. What type of controls or processes can we create to ensure that those risks that we cannot control, we can, or that we cannot control, we can mitigate? And then also there's risk due to the nature of the client and the business. Now, when we're talking about we're talking about client acceptance or continuance. Okay, there are, under our audit standards, there are preconditions that have to occur for an audit. And there are four major preconditions. Okay, first of all, we have to determine that management uses an acceptable financial reporting framework. In other words, not something that is custom made that nobody can understand or is a one-off, but we have to understand, or that the management understands, it must use an acceptable financial reporting framework. We talked about GAAP, we talked about IFRS, we've talked about special purpose frameworks, and there's a number of other frameworks, but it has to use an acceptable financial reporting framework. Management must understand that it has a responsibility for the preparation and fair presentation of the financial statements. In other words, it gets back to the financial statements are not those of the auditor. They are the responsibility of management. Number three, management understands its responsibility for the design, implementation, and maintenance of internal control. Now, we talked about the basically the management's control environment. And what that means is management needs to understand that it is responsible for recognizing its own business risks and for developing the proper control environment to help mitigate those business risks. Also, management has to also understand its responsibility to provide access to all information and persons deemed necessary for the audit. Now, if these preconditions cannot be met, the auditor should decline the engagement. Okay, let's try number 4. Which of the following factors would likely cause an auditor to decline an audit engagement? A, failure by the client to satisfy the preconditions of an audit. B, inability for the client to provide a retainer fee for the audit. C, the audit must be scheduled too close to the year end. In other words, we don't have enough time. D, the auditor is unfamiliar with the client's industry. So again, review your responses, stop the video, and when you're ready, restart to review the correct answer. Okay, the answer to number 4. which of the following factors would likely cause an auditor to decline in an audit engagement? And the answer is A, failure by the client to satisfy the preconditions of an audit. And we can see where I've reproduced that information from the previous slide. Again, if the auditor should decline the engagement if the preconditions for the audit cannot be met. Now, again, with client acceptance and continuance, if we have a continuing client, one of the things is that sometimes when we're going to start or they want us to engage in a new audit, basically, a request by management to change the terms of the engagement should be evaluated for its reasonableness. In other words, if we're changing it from the prior year, if those terms are unreasonable, the auditor should withdraw and communicate the reason uh, they're going to terminate the engagement, and basically they should communicate that with those individuals, typically again the board or the audit committee, the board of directors, with those charged with governance. Now, again, if we're talking about a new client, this in a lot of cases requires some additional work, and this again comes out of our audit standards. So let's assume that we have a new client, and we're going to basically one of the things audit standards require is that the auditor should communicate with the predecessor auditor. In other words, if this is a new client, they're probably going to have a predecessor auditor before accepting the engagement. So the audit standards says the auditor should, and then doesn't say must, it should communicate with the predecessor auditor before acceptance of the engagement. In other words, this is something we need to consider, but if we don't want to necessarily do it because we have other methods, we don't have to, but again, we have to have a good reason. Now, one of the things is that the AICPA Code of Conduct, Rule 301, doesn't matter what the rule number is, but it requires the audit. Here's what's really important. It requires the auditor to obtain permission from the prospective client before communicating with the predecessor auditor. So in other words, the auditor, the predecessor auditor is under no obligation to speak to the new auditor. As a matter of fact, the predecessor auditor, by basically by the rule of confidentiality, can't share any information without the permission of the client or the old client. Now, the client's refusal to grant permission to contact the predecessor auditor, or the predecessor auditor failing to respond, requires the present auditor to fully consider the implications of accepting the engagement. Now you notice it says it doesn't need, they don't need to turn down the engagement, but they need to fully consider the implications. Typically, if the client says, no, I don't want you talking to the auditor, that kind of raises kind of like a red flag. What's going on? What's the problem? There are some cases where predecessor auditors, for whatever reason, basically just don't respond, although they are normally required under the Code of Conduct to respond. But there could be in some cases where the predecessor was a small firm and the firm dissolved and basically disappeared, or it was a single CPA and that single CPA, let's say, died. It's harder to contact them under those circumstances. But again, if we're going to communicate with a predecessor auditor standards say basically we should inquire as to the facts that are relevant to the integrity of management. Number two, we need to inquire as to any disagreements with management about accounting principles, audit procedures, or similar matters. Number three, communications with those charged with compliance. In other words, like the audit committee of the board of directors about fraud and non-compliance with laws and regulations. In other words, of the predecessor auditor did you have to communicate with them regarding compliance about fraud and non-compliance, laws, regulations? Communications, again, with the predecessor auditor, communications to the management and those charged with governance about significant deficiencies in internal control, or you can also say significant deficiencies in the company's control environment. And lastly, the predecessor auditor's understanding as to the reason for the change in auditors. Okay, some additional information regarding communications with the predecessor auditor. Again, remember the successor auditor must obtain sufficient appropriate audit evidence to afford a reasonable basis for expressing an opinion on the financial statements the firm hasn't been engaged to audit. Now, basically, the information that the successor auditor is going to also may also request is the most recent audited financial statements, the predecessor's audit report, the results of inquiry of the predecessor auditor, and predecessor auditor work papers. Again, that's given under Rule 301 that the client is given the permission to access this information. Now, something else though that's important is that with the successor auditor, in reporting on the audit, the successor auditor, in other words, the audit of the successor auditor should not make reference to the report or work of the predecessor auditor as the basis in part or as a basis for or in part for the successor auditor's own opinion. Now, what's a predecessor auditor? Basically, the definition is a predecessor auditor is considered an auditor who's reported on the most recently audited financial statements, or who was engaged to perform but did not complete an audit of the financial statements, or who has resigned, declined to stand for reappointment, or been notified that his or her services have been or may be terminated. So that's the definition of a predecessor auditor. Number 5 now. Before accepting an audit engagement, a successor auditor should make specific inquiries of the predecessor auditor regarding the predecessor's evaluation of all matters of continuing accounting significance, B, fees receivable. 5, before accepting an audit engagement, a successor should make specific inquiries of the predecessor auditor regarding the predecessors. And the answer in this case is D, understanding for the reason for the change of auditors. Now, A says evaluation of all matters of continuing accounting significance. This normally is going to be, this is something that's going to be important, but it's after the auditor has accepted, in effect, accepted the engagement and the inquiry with the predecessor auditor has already been done. B, fees receivable balance with the prospective client. Again, that's not normally pertinent to the inquiry. C, awareness of the consistency of the application of GAAP. And again, that would be not before typically the acceptance as the acceptance of the new client. So D is correct. Okay, number 6, before accepting an auditing engagement, a successor auditor should make specific inquiries of the predecessor auditor regarding the predecessor's A, the degree of cooperation received from the client's legal counsel, B, the predecessor assessment of inherent audit risk, C, disagreements the predecessor had with the client regarding the application of accounting principles, and D, the internal control environment. So again, review the answers, and when you feel you've selected the correct answer, again, I should have mentioned stop the video, but you've probably done that. So now go ahead and restart the video and look at the correct answer. Okay, number 6, before accepting an audit engagement, a successor auditor should make specific inquiries of the predecessor auditor regarding, and the answer is C, disagreements the predecessor had with the client regarding the application of accounting principles. Number 7, which of the following would not be an inquiry that would be made of the predecessor auditor prior to accepting an engagement? A. Communications to management and those charged with governments regarding significant deficiencies and material weaknesses in internal control. B. Request for a client to grant predecessor auditor to allow successor auditor access to the predecessor's work papers. C. Information that might bear on the integrity of management. D. Communications to those charged. Now we need to talk about another audit standard requiring what we call the audit engagement letter as part of our preliminary engagement activities. And the audit engagement letter is under the clarified standard AU-C 210. The premise is the auditor should agree with management or those charged with governance upon engagement terms only if the preconditions for an audit have been met and a common understanding of terms have been reached. This common understanding / agreement should be documented in an engagement letter. And these are the items typically that should be included in an engagement letter. Now, it doesn't mean that these are the only items, but this gives an example of the items that should be in an engagement letter. And that includes, again, the agreed upon terms of the audit engagement should be documented in an audit engagement letter or other suitable form of, again, written agreement. It should include the objectives and the scope of the audit of financial statements, the responsibilities of the auditor, the responsibilities of management. A statement within the letter that because of inherent limitations of an audit, together with the inherent limitations of internal control, an internal control system or environment, an unavoidable risk exists that some material misstatements may not be detected even though the audit is properly planned and performed in accordance with generally accepted auditing standards. So what it's saying is the audits aren't perfect. Identification of the applicable financial reporting framework for the preparation of the financial statements, and reference to the expected form and content of any reports to be issued by the auditor, and a statement that circumstances may arise in which a report may differ in its expected form or content. Now, what I'll also tell you is that this is just at the tip of the iceberg for the audit engagement letter. The standards also require, I shouldn't say require, but they also suggest a number of other items that the auditor may want to include within the engagement letter. What I've tried to do here is just maintain the higher level understanding of what should be in the engagement letter. Again, the engagement letter itself must be signed or acknowledged in some official way by the client. Now, another thing is that as part of this engagement letter process, what we could find out is that, so if management imposes scope limitations, and those scope limitations could lead the auditor to believe that that's going to result in the auditor eventually disclaiming the opinion on an opinion on the financial statements, the auditor should not accept that engagement as an audit engagement. Now, what I've done here is I have inserted the sample engagement letter from the appendix of the clarified standard AU-C 210. Now, this you do not have to memorize, but it talks about these are some of the example items that you may want to include, or a lot of firms have just basically copied, pasted, and basically uh, modified as need be. Again, you can read through this. There is a hard copy, or there's a PowerPoint presentation that also contains this uh, if you want to study a little bit more. But I'm just kind of going to go over this very closely, or very quickly. Again, it's to the appropriate representatives of those charged with the governance of ABC Company. The engagement letter will talk about the objective and the scope of the audit. Then we'll talk about the responsibilities of the auditor. And again, we talk about, as it says up here, because of the inherent limitations of an audit and internal control, we can't guarantee, basically, we can't guarantee that we won't fail to detect material misstatements. Then it goes on, the responsibility of management and the identification of the applicable reporting framework. And then basically the information that we must be provided with, any other relevant information, and then as they say here, insert other information such as fee arrangements, billings, and other specific items as appropriate. So that is the example, the engagement letter. Again, you can view that as part of AU-C210 if you want to really read it. I've also got the copy of it in the PowerPoint presentation for this class if you want to look at it in detail. And down here, then we talk about the reporting part of it. Basically, in terms of what type of reports will be issued and so forth, and it goes on. Okay, now there are times when there are changes to the, in effect, the audit, the engagement letter. And if there are changes, they should be written up as addendums to the engagement letter and signed by the auditor and the client. So the auditor should never agree to a change in the terms of the audit engagement when there's no reasonable justification for doing so. In other words, the engagement letter was written for a certain reason, and if there's a reason to change it, there should be a reason why it is that the client wants it changed. If prior to completing the audit, the auditor is requested to change the audit engagement letter to an engagement for which the auditor obtains a lower level of assurance, in other words, no longer a formal audit report, the auditor should determine whether the reasonable justification for doing so exists. In other words, sometimes the client can enter into an agreement where they wanted an audit report, and later on they find out they really don't need the audit report. Let's say that they need the auditor to perform some other type of what they call lower level of assurance. And under those conditions, the auditor has to determine whether or not that justification exists. So now, if the auditor concludes that no reasonable justification for a change in the terms of the engagement exists, and is not permitted by management to continue the original audit engagement, the auditor should, number one, withdraw from the audit engagement when possible under applicable law or regulation. B, or number two, communicate those circumstances to those charged with governance. And C, determine whether any obligations, either legal, contractual, or otherwise, exist to report the circumstances to other parties, such as owners or regulators. Okay, number 8 and the last question for tonight, and second to last slide. Which of the following matters is generally included in an engagement letter? Fee and billing arrangements, management representations, responsibility of the auditor and management in the audit, or D, financial statements to be audited. So again, take a look at the answers, stop the video, and when you're ready, restart the video and review the correct answer. And the answer is, which of the following matters is generally included in the engagement letter? And this would be B, detailed management representations. And you can see the information uh, basically here, or basically as the agreed upon procedures. And with that, that is the end of our rather lengthy video tonight, or today, depending upon when you view it. Thank you.